Did you know that Crombie Real Estate Investment Trust, traditionally known for its retail-focused portfolio, is now eyeing a foray into the multifamily market? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. Crombie Real Estate Investment Trust, commonly recognized for its substantial retail-focused assets, is making a strategic shift towards multifamily developments. According to a recent article from ranks.ca, Crombie's president and chief executive officer, Don Clow, shared insights at a CIBC real estate conference about the company's plans to diversify its portfolio by leveraging existing properties and their air rights for mixed-use and multifamily projects. Crombie's portfolio, which currently consists of 280 commercial properties anchored by grocery and drugstore chains, is valued at approximately $4.8 billion. Despite its strong retail foundation, Crombie sees significant potential in transforming some of these assets into multifamily residential units. They aim to develop up to 6,500 units, equating to a $3 billion opportunity, primarily through properties acquired, including the Safeway portfolio. The focus is not just on short-term gains, but long-term wealth creation. Crombie plans to build a purpose-built rental apartment portfolio, prioritizing rental income over selling condominiums. An example of this strategy is a project on Davie Street in Vancouver, expected to yield 6% returns with the anticipation of 3% annual rent growth in the market. Crombie's initial development efforts will concentrate on 19 sites across Canada with a significant presence in Vancouver, alongside Calgary, Toronto, and Halifax. They are also exploring opportunities beyond their current pipeline, targeting other grocery store-anchored sites for potential acquisition and redevelopment. This strategic shift by Crombie Real Estate Investment Trust highlights a growing trend among retail-focused landlords to diversify into the multifamily sector, aiming to unlock the value of their existing real estate assets. With long-term wealth creation in mind, Crombie is poised to make a significant impact in the multifamily market. Recent data from the Canadian Real Estate Association is signaling a potential shift in the real estate market that's reminiscent of the 1990s crash. According to Stephen Punwasi's article, the sales to new listings ratio, or SNLR, for June fell to 49.3%. This marks the weakest demand balance for the month since 1995. The SNLR is a key metric for gauging market conditions, and its current level suggests we're in a balanced market. However, the rapid decline from previous highs is raising eyebrows. The SNLR's decline was driven by an 8% increase in new listings, outpacing the 3.5% rise in sales. This has led to the fourth consecutive June where the SNLR has dropped, resulting in a significant 23.8-point decline from peak to trough. Historically, such a rapid shift hasn't been seen since the late 80s, when the market was on the brink of a major downturn. So, what does this mean for the multifamily sector? Well, while the overall market shows signs of cooling, this could be an opportunity for multifamily investors to capitalize on the changing dynamics. With more listings coming onto the market, there may be opportunities for acquiring properties at more reasonable prices, especially in regions like Hamilton, Kitchener-Waterloo, and Oakville. It's important to note that while the SNLR indicates a balanced market, the direction of the change is crucial. A balanced market today might still experience price fluctuations if demand shifts suddenly. For investors, this means staying informed and ready to adapt to these market changes. As we look at the current landscape, it's clear that the multifamily sector remains a resilient option for those looking to build long-term wealth. The fundamentals of supply and demand will continue to play a crucial role, and savvy investors will find ways to leverage these shifts to their advantage. By focusing on areas with strong economic growth and population increases, the multifamily market can still offer promising returns. Moving on to another exciting development in the multifamily real estate landscape, KRP Properties is making waves in Canada's largest tech park by converting a 10-story office tower into residential apartments. This project is located in the Canada North Business Park, a hub for research and development, making this transformation a fascinating case of adaptive reuse. According to Don Wilcox from RENX, the former office building at 535 Leggett Drive is being transformed into approximately 115 apartments. KRP Properties, owned by Ottawa tech entrepreneur Terry Matthews and his holding company Wesley Clover International, is behind this ambitious project. The building, originally constructed around the year 2000, features a glass metal curtain wall construction, making it a prime candidate for residential conversion. What's particularly interesting about this conversion is its location in the heart of a tech hub. Canada North is home to over 200 tenants, including major players like Ericsson and Nokia, employing around 12,000 people. This creates a significant potential resident base for the new apartments, especially with many tech workers seeking housing close to their workplace. The development team, including NEUF architects from Montreal and RECL Contracting of Ottawa, is working hard to ensure the project meets the demands of this tech-savvy community. The apartments will offer high-end amenities, leveraging the proximity to the adjacent Brook Street Hotel, known for its popularity among business executives and visitors to the area. KRP's approach also includes sustainable construction practices, aiming to meet the equivalent of LEED Gold or Platinum standards. They're focusing on reusing materials and implementing advanced HVAC systems to enhance energy efficiency. This commitment to sustainability is becoming an essential factor in modern real estate development, appealing to environmentally conscious tenants. As the only apartment complex in the immediate area, KRP's project is poised to set a new standard for residential living in Canada North. There are also plans for further development in the area, with Main plus Main and Nokia eyeing additional residential projects. This evolution of the tech park into a mixed-use community could significantly enhance the local living and working environment. This office-to-apartment conversion by KRP Properties is a testament to the adaptability and forward-thinking approach required in today's real estate market. By repurposing existing structures and aligning with the needs of the tech workforce, KRP is not just creating housing but fostering a vibrant community where innovation and living intersect. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.